Hello and welcome to the next episode of the Self-Development with Tactics podcast. And today, as you can see in the background, if you are on a YouTube video or on the stream, we are going ahead with the investing, topic. We've been speaking out yesterday as well, and which is from the book Unshakable by Tony Robbins. And I'm currently on the paulminus.com website. It's a great website. It's a really, really, really in-depth summary of the book, which is pretty great because, as you might know, unfortunately, all the other book sites kinda either aren't that good anymore, or I just have gone through all the fucking summaries they have on it, or they just were like, yeah, you have to sign up to go ahead and so on. I could go in with a VPN, so a virtual private network, but it doesn't feel quite right because these are actually quite a lot of first of all experiences and value, and making these summaries is for sure a pretty hard work, and a pretty intensive work as well. But because I didn't really know, or do not know by now as well, where I've stopped yesterday, I will just go on with taxes, because I think it was actually the point where I stopped yesterday, some sorta. I'm not quite sure, as I said, but it kind of seems true because about how to pick one, but you can't actually see it. So now you can see it. Now you can see it. So now I can prefer, or just have to see. No, wrong way. Just forgot to do it right so that I do not get disturbed and there aren't just some crazy sounds going on here. So, but I think we will go on with taxes. So when two people trade a stock, one must win and one must lose. If the stock goes up after you bought it, you win. But if you got to win, but you have got to win by a big enough margin to cover those transaction fees or transaction costs, which is actually something I've been speaking about yesterday, but it's pretty important to just really point it out that you should be clear of that you really choose stocks, or just choose the right stocks to invest in, that actually bring you the right amount of money so that you can pay the transaction fees or costs and then have a win nevertheless, or anyways, which is pretty true. And I think as a beginner, which I am, it is pretty important to just look at the basics. And even though a lot of things seem obvious in life and seem obvious to a lot of persons, some people aren't just thinking about it, and so this is really, really quite troubleshooting for them. So if your stock goes up, you will also have to pay taxes on your profits when you sell the stock, which is totally true, because I think it's either I would even say that's the state who wants the money because of these transactions, or it may be I don't know, maybe they tell me. So you have to pay taxes on your profits when you sell the stock. For investors in an actively managed fund, this combination of hefty transaction costs and taxes is a silent killer, quickly eating away at the fund's returns, or all the fund's returns. So this largest expense in the life is taxes, and paying more than you need to pay is insane and doesn't make any sense. So, if there is any way to just, be a little bit sneaky and so that you do not have to pay as much taxes, then you should probably do it. If it's legally, if it's not legally, I really do not want to say that you should do it. You should definitely not be doing it because, actually, yeah, in the short term you get a lot of fucking money. But in the long term, you might get into prison, and then everything might be fucked up, and you still have to pay everything back. So, yeah, I'm always about the long term, because I think the long term is quite the best option all the time. So yeah. Yeah. So your profits could be slashed by 30% or more unless you're holding the fund inside a tax-deferred account, such as an IRA, which is an individual retirement account, yeah, or an 401k plan. And not surprisingly, fund companies don't like to dwell on these taxes issues, preferring to tout or whatever their pre-tax returns. If the fund is held in a non-taxable account like a 401k, you're looking at a total cost of 3.17% of the stock, or of holding the stock maybe a year. And with a taxable account, this might be 1% up, which then would be 4.17%. And I've been speaking about yesterday, about the same issue and the same thing. But the thing is, I do by now, also think that this 1% is just, a lot of fucking money. If you just, count it with, or just calculate it with $1 billion or even $1 million, this is just quite a sum. This is quite a lot of money. Quite a lot of money. Seemingly tiny fees can mount up until you have lost almost 2/3 of what you would have had, which is, quite a lot. A third of, which is 33.3333%. This is quite a lot, man. This is quite a lot. But who can you trust? Pulling back the curtain on the tricks of the trade. The more money you have, the more likely you are to seek out advice, which makes total sense, because if you have more money, you will probably be investing more money into stocks and or real estate or anything else. And if you're just handling, I don't know, $5 billion and you do not know shit about investing, I would probably get an advisor too. But the thing is, often, they charge fees as well. And so it's, always kind of, important to see and just to watch that they cost something, and then to really be sure how much you get out of it and if it's even, worth all the efforts. But yeah, 81% of people with more than 5 million have an advisor. But how do you find an advisor you trust, and who deserves your trust? Unfortunately, financial advisors work in a system that's beyond their control, a system that has tremendously powerful financial incentives to focus on maximizing profits above all else. This is a system that richly rewards employees who put their employers' interests first, their own interests second, and their clients' interests a distant third. 90% of the roughly 310,000 financial advisors in America are actually just brokers. And I do not actually know what a broker is. I think this is just someone who is just at the market, at the stock market. I don't know if, really physically or just virtually. But yeah, so a top city broker is a dealer. Yeah, okay. A person who buys and sells goods or assets for others. Oh, okay. This function of Apple is so immensely great. You just, press hard into your mousepad, and then you get the, all these informations, the English thesaurus, the German translation as well, and, you can always choose another dictionary and so on, and actually the news. This is just great, and, maybe not so great that you can't see it actually, but yeah. So in other words, they are paid to sell financial products to customers like you and me in return of a fee. And the odds of finding good advice improve dramatically if you steer clear of all brokers and work instead with independent advisors who have a fiduciary duty to put your interests first. The good thing about brokers at my point of view, and if I get it correctly, is that brokers get fees for the amount of money you or they make you, which means that if they make more money for you, they get more money out of the system. The bad thing then with people who are just some kind of only employees, who just have their fixed wage and, have their fixed hours and everything fixed, they won't be like, yeah, I'm spending this extra hour to get, this fucking millionaire another million. They won't be like this, at my point of view. So, I maybe would be doing it because it would be just great for the millionaire to just, get another million just because of me. This is just, incredible leverageable. But the thing is, for the brokers actually, if you are a broker, you would definitely be doing it. No whether, what discipline you have or, what worldviews you have. Doesn't matter. If you just get more money out of the system by doing this, everybody would do it. So how do you pick one? First, check the advisor's credentials, which is some sort of, I think, what he did before or she. Ideally, you're getting an advisor, you should be getting more than just someone. Sure, they have experience working with people just like you. It's also important to make sure you and your advisors are aligned philosophically, which kind of means that you kind of have the same work ethic, I guess. It's important to find an advisor you can relate to on personal level, which is, I think, some kind of you like him, because I you know I'm going to have some kind of last, how should I say, it's my diploma. I'm going to do it, and we have a practical work there, or practical thing we have to do. And the thing is, our teachers just tell us that we should actually be working with people whom we know have, great skills that we actually need for our project. And you shouldn't be pretty much looking for your friend or whom you like or whatever. But I actually think that's total bullshit. It makes sense, yeah, to look for people you know that they have skills you need and that they are good at what they're doing and what you need them to be doing. This is great, especially for employers and so on. Yeah, but the thing is, I do not work so much with people, if I can really choose it, that I do not like, or I do not know that much. This would be just self-destructive at my point of view, because you can't just work in that kind of feeling, and you do not have maybe the same philosophy, and it's just a little bit strange. So yeah, I think this is meant by the last point, the fifth point. A world-class advisor will help you immeasurably from start to finish, defining your goals, keeping you on a steady path towards them actually, in particular by helping you to weather market volatility and massively increasing the probability that you'll actually achieve those goals. Because it makes sense for him, if the advisors just get more money if they make you more money. This would then make total sense. So 7 key questions to ask your advisor. Are you a registered investment advisor? If the answer is no, this advisor is a broker. The second one is, so it seems like so everybody could be a broker? Is this the thing? This would be some kind of strange, but maybe it's just easier to get a broker than to get an actual investment advisor, because maybe you just have to study something to be investment advisor, maybe investments actually, if this is even some kind of term. But yeah, the second one is, are you or your firm affiliated with a broker dealer? If the answer is yes, then walk away. Yeah, that makes sense. The third one is, does your firm offer proprietary mutual funds or separately managed accounts? Hopefully the answer is no. It's actually, quite a strange question if you just ask like, yeah, does your firm offer private mutual funds or separately managed accounts? And when the answer is no, is it for the first one or the second one? I don't know. The fourth one is, do you and your firm receive any third-party compensation for recommending particular investments? Which means that, they get they got paid, sorry, not bite, maybe. They got paid by other firms or just, other companies, that they actually be like, yeah, invest into these things because, then they get the money and so on, which makes total sense to ask that. You need to know that your advisor has no incentive to recommend products that will shower him or her with commissions, kickbacks, consulting fees, trips, or other goodies. The fifth one is, what's your philosophy when it comes to investing? The sixth one is, what financial planning service do you offer beyond investment strategy and portfolio management? And the last and seventh one is, where will my money be held? A fiduciary advisor should always use a third-party custodian to hold your funds. And I don't have any clue what all these things are. But the thing is, unless you aren't in a position to really invest, which is, the same, this is just, the position I am in. I'm just pretty much, looking at how I can actually invest. And then maybe I can, look at some advisors if I know a little bit more about all this investing game and so on. Section 2, the unshakable playbook. 4 principles that can help guide every investment decision you make. And I think, and this is just a really great, moment for me, that I can put some self-development into the whole thing in terms of decision making. In my point of view, and this is actually something I kind of found out for myself, or it, kind of feels like it, even though I'm pretty much sure that a lot of people have thought about it as well, and, also spreading it as well. But I'm gonna tell you anyways. At my point of view, all your fucking decisions should be only based on your values and goals. And if they're really based on that, and if you just really choose your decisions or options through your, through your goals and your values, you will always make the great and right decision. Because the thing is, if you have a goal, for example, the goal is to get, the goal is to have $7 million in your bank account by 2030. Then the thing is, you have 3 options. The first one is pretty cheap. The second one is, in the middle area. And the third one is pretty expensive. And if you would be just, deciding based on your values and or in this terms, or in this, scenario, in terms of your really goal, then you should be, choosing the cheapest one, because you you aren't really into losing money, because you need the money, because you want the money to be so much in 2030. If this makes some kind of sense now, I hope. So the 4 principles that can help you make better investment decisions, or make actually investment decisions. The first one is, don't lose. And this is actually something Warren Buffett is also been telling people, which is, quite a famous quote of him, I guess, that you should should never lose money, which is, some kind of dumb advice, not dumb, but some kind of silly and obvious, and, it just makes sense. But the thing is, it is so obvious that I think that people aren't thinking about it. So the thing is, don't losing money just means for me not making dumb decisions or stupid decisions or decisions you already know that they will, fire backwards and so on. And the best investors are obsessed with avoiding losses. Why? Because they understand a simple but profound fact. The more money you lose, the harder it is to get back to where you started. That's actually true, because making a lot of money through the stock market with a lot of money is much easier to make a lot of money in the stock market with not so much money, or just really few money, which makes sense because you then have or could buy more stocks and resell it more. And so it's just some kind of exponential, because if you just buy 20 stocks, if you say it like this, if it's just, a count, if you just buy 20 stocks of $100 and each of these just, grow by 20%, these will just sum up and sum up and sum up. And so you get a lot of money out of it. So, this just makes sense. Is there a chance of the next big market collapse? I think there actually is, to be honest. So just to tell you, I'm not knowledgeable in this field, so I do not have any clue about investing. The thing is, if you know Gary Vee, he is telling a lot about the market, collapsing in the very future, which makes sense to me because, it actually crashed in, if I'm rightly educated, in 1999, in 2001, and in 2008. And this is also just some kind of decade away from now, or go or in the past from now, which makes the market a little bit unstable or not quite in balance. It would make sense that the market will collapse in the future because the last collapse was such a lot in the past. I wouldn't say so, man. Refugees are great. You know why? Because if you would be in their position, you would also like to be. I don't know if you're just referring to Europe or referring to whatever, and they are just people as well. So, yeah, they are just people, and you would like to be in a better country than you were before as well. So, yeah. Yeah, talk to the mirror. No, to my not really, existent audience. But yeah. The second one is asymmetric risk and reward. Uh, Asymmetric risk and reward. You need to take big risks to achieve big returns. The best investors don't fall for this high risk, high return myth. Instead, they hunt for investment opportunities that offer what they call asymmetric risk reward, which means that, the axis between risk and the return of it is just, not really just parallel to each other. So, it's low risk and high return, which would they be aiming for, and not like the other way around, which then would be low return and high risk, which doesn't make any sense to invest in such a position or such a thing. You're doing great, man. Man, wasn't this just some kind of meme, or if I'm just quite wrong now? I just thought about it. Was it a meme, man? I think it was. But yeah. It ain't a meme. You sure? You really sure? I didn't say that. I didn't say that, man. So, but yeah, let's read along. Which is a fancy way of saying that the reward should vastly outweigh the risk, which is just the same thing as I was just explaining before. The third one is tax efficiency. Taxes can easily wipe out 30% or more of your investment returns if you are not careful. Yet mutual fund companies love to toot their paratax returns, obscuring the reality that there is only one number that truly matters, the net amount that you actually get to keep. Yeah, this would make sense. I think at my point of view, there are just some kind of ways to return or just, to reduce taxes in some kind of legal way, which is if you have a company, there's, some kind of ways you can, actually in my country, I don't know where you're from, but the thing is there are actually some ways where you can, buy things through your company so that you can just return some taxes because of some way. I'm not that educated in this position or in this kind of field, so I can't help you, man. But maybe you just, Google it and see if there are just some ways. And aren't there some ways in your country to just, get a little bit of your taxes back every year? Or so. But yeah. Because the question came up, so for the podcast listeners and for the YouTube watchers, if there is any way to reduce the taxes a little bit, because they are actually pretty high. They take a lot of your wage and so on. So yeah, I think there are some ways, but I'm not quite into this field, so I might be the wrong person to ask. The fourth one is diversification, don't pull all your eggs in one basket. And this is actually what I'm doing, and this is just really great that this comes up. This is what I'm doing with the whole social media thing. I'm not only doing YouTube, I'm not only doing streaming, I'm not only doing Instagram, and I'm definitely not only being or doing Twitter. Why? Because if one goes down, if one just sucks and goes down and collapses, I don't know, then I just, I'm backed up by all the other platforms I'm on. And this is why it's just, at my point of view, dumb to only have one social media channel, or just one burger or one stream of income, because if one goes down and if you only have one, this is just really, really, just imbalanced, and it's just really, kind of, you should be a little bit, I don't need word. I actually need some words, man. You actually should be a little bit scared, because if the one resource of money you get, or the one resource or stream of income you have goes away, you're just completely fucked. Through what should you be living? That's actually the thing why, the average millionaire has actually 6 or 7 streams of income, because, he just backs himself up. If this industry goes down, he then just have the other 5. If one of the other 5 goes down, he just have then the other 4. So he is always safe. And this is the same thing with, investments, which makes sense. And it's the quite same thing with social media. If Twitter sucks and it goes down, I still have Instagram and all the other things. Yeah. So how to navigate crashes and corrections to accelerate your financial freedom. If you live in fear, you have lost the game before it even begins. Because fear doesn't make any sense nowadays. At my point of view, fear was just something that nature created, or just nature put into us to, to some kind of force us to not make some stupid shit. But nowadays there aren't any predators or just any animals, wild animals, or just, anyone whom we should be feared about. So just nobody. There is nobody. And the thing is, then just the fear sucks, because it prevents us from doing great things, because our body some kind of feels like that these are actually some things that, aren't that good for us, even though these are just some stupid fucking fears that shouldn't be there. But nature is just, such a great thing, because it is so fucking interesting how many things that, were just really early and really important feelings and or just factors for us in our really early days, which are now just, pretty irrelevant, or just in terms of body language are just pretty interesting now, which is interesting. So how to navigate crashes and corrections to accelerate your financial freedom. If you live in fear, you've lost the game before it even begins. How can you achieve anything if you're too scared to take a risk? You can never know what the stock market will do, but that uncertainty isn't an excuse for inaction, which is totally true. And you will never be definitely or just really accurately knowing what you should be doing. The thing is, should you just start the car Instagram blog? Or Instagram page, or should you just, start the soccer Instagram page? So what should you do? The thing is, if you, like both topics or both sides the same, just flip a coin, because you only see at the end of your life some kind of, or maybe, what decision would have been actually the best one. But now you can't just guess or throw a coin. And this is actually something that I'm willing to do a little bit more often, because there's just so fucking often just really stupid decisions I have to take, but at the end I really know that, it doesn't matter if I take this one or if I take that one, but I still, do really, really think about it. But it doesn't make any sense. Prepare for the bear. So bear market is when the stocks crash or go down by 20% from their peak, as they was telling us in the first kind of half, I hope so, kind of half of this article and or of this book summary. So here's what you have to remember. Based on more than a century of history, the short-term outlook may look dire, but the stock market always rebounds. This historical perspective gives me unshakable peace of mind, and I hope it will help you to keep your eyes on the price. Regardless of the corrections and the crashes we encounter in the years and decades to come, the best investors know that the gloom never lasts. How to prepare for the next bear market by constructing a diversified portfolio that reduces your risk and enhances your returns. As a financial advisor, I construct a client's portfolio by combining asset classes, each with different risk characteristics and different rates of return. The goal, to balance the return you need to achieve with the risk you're comfortable taking, which just means that which is just kind of related to not putting all your eggs in one basket, but just having some different kinds of stocks. Some may have a really high risk and a really high return, but some others really have, low return and low risk. And, another one would be just, in terms of the axis, just, imbalanced, so high risk, low return, or the other way around. And it makes just sense to really be investing in all 4 or 3 or just, there are quite a few types, to be really investing in all of them. Because just if one, isn't doing that great, another one maybe is just really doing great. And so you're just never going into the minus, but some kind of actually never going into the plus really deeply as well. But the thing is, if all go up, it's great. If all go down, maybe not so great. But as they were saying before, the market will always rebound, and so everything will be good, in some day. Customization. Asset options involve stocks, bonds, and alternative investments like real estate. I didn't actually know that this is known as an alternative investment. Real estate, private equity funds, and gold. In reality, the types of assets should be matched to what you personally need to accomplish. Which makes sense, because actually all these investments just have, their own characteristics. I don't know them, but I assume that they have them. What asset classes will give you the highest probability of getting from where you are today to where you need to be? In other words, the design of your portfolio must be based on your specific needs, which is just always, the thing. If you're just working out and you have a specific working out plan or plan to work out, you will definitely be doing just more progress than, kind of doing some average plan for, the average American male or some shit. This makes sense. And so asset allocation drives return. Deciding on the right balance of stocks, bonds, and alternatives is the most important investment decision you will ever make. The moral: never bet your future on one country or one asset class. Which makes sense, because as we might know, or actually know by now, that you shouldn't, really be putting all your eggs into one basket. Use index funds for the core of your portfolio. Always have a financial cushion, which means that you shouldn't, if your wage is $700, which is fairly low, I guess, and you put in 650 so that you can barely live, might not be the best idea. So if just, something happens, you're just completely fucked. And this is never a good idea. Just, going all in should be only done if you really, really exactly know it. So this is my point of view. If you just really exactly know that this will go good, this will go well, you're safe, and there are no just, high risks. But the rule of 7, ideally, we like our clients to have 7 years of income set aside in income producing investments such as bonds and MLPs. If stock crash, we can't tap these income producing assets to meet our clients' short-term needs. And this was actually it with the book. I'm quite surprised, because I was thinking there might be, oh no. Uh, I was really surprised, and I couldn't really believe it right now, but this actually isn't the end. This is quite a long way to go from there, and I actually think that there may be a third episode, tomorrow. But actually, I hope that you're getting a lot of value out of it, as a lot value. So as I'm just, getting out of it. But yeah, I actually have the 7 facts. No, it wasn't this. Where should I put my money? No. Compound interest, 7 facts to fee you from. Blah, blah, blah. Oh no, I'm in the beginning. Sorry. I've gone through this one. Prepare for the pair. This was just, the latest one. Yeah. So the section 3, the psychology of wealth, and this is just, I think, the really, chapter where Tony Robbins is just really blowing up in some kind of good term, not, some kind of bad term, because this is just, some kind of field of experience. He's, at my point of view, a pretty good speaker and a pretty good analyzer, and, and this is just something I've been thinking about lately, is that, if someone comes up to you and you're on stage and asks you a question, that you are actually in a position to really help them and give them a good, answer for the question, is actually pretty hard, because you never know what questions appear. The thing is, then you really know that he or she or whatever is a real expert in their field. Because if they then just be like, I don't know, like I'm doing, then you really know that he or she isn't a pretty expert in this kind of field. But yeah, so the psychology either makes you or breaks you. So it's imperative to have a robust system that enables you to stay on target. 80% of success is psychology and 20% is mechanics, which is always the thing. It's also the thing with working out. It's 80% nutrition and 20% working out, which makes total sense, because, if you just eat way too less and your goal is to build muscle or build, or gain weight, if you just eat way too less calories and you work out like, crazy, you will, maybe even just losing weight because you just don't eat. And it might be even, the same thing with quite everything, because I've seen it so often that it is actually the right thing. Maybe this is some kind of secret nature thing that's, in life. I don't know. The 6 biggest mistakes investors make and how to avoid them. The mistake 1 is seeking confirmation of your beliefs. Why the best investors welcome opinions that contradict their own. For investors, confirmation bias is a dangerous predisposition. Let's say you love a particular stock or fund that's performed exceptionally well in your portfolio over the last year. Your brain is wired to seek out and believe information that validates your owning it, which is totally true, which is actually something that I've been reading in a psychology summary on the channel and or on not on the stream. This is a little bit a time ago, but this is actually the thing, and this is actually something you definitely have or had experienced before, that if you just really like something and you want this option to be the right option, you just search for so fucking many resources or sources that really validate that this is the correct answer and this is the correct option you should actually be taking, even though you just kind of manipulate yourself to really taking this one, even though it's not the best. And so I've been really watching out in terms of myself, so that I do not do this shit, because it doesn't make any sense. But how did I do it? I just some kind of thought about it all the time. I was seeking some information for some things that I'm quite into, some kind, or just really passionate about. You could also say that, but you know what I mean. So just really be conscious about it. But yeah, the solution: ask better questions and find qualified people who disagree with you, which then makes sense. And then you might be a little bit back and forth action, and then actually maybe you are right, maybe you're wrong, but the thing is, then you will be seeing. and you will be just, it's just good for you to also some kind of some kind of be wrong, because, or just having made a wrong decision some later or some time ago, because then you just, wait for the best moment to sell those stocks, sell them and buy something else. And just if you hold them and hold them and hold them and they lose their whole worth and everything goes down and so on, and you're just losing money and losing money and losing money, this just sucks more than, just having the short term disapproval of just, being not right or just being wrong. But yeah, mistake 2, mistaking recent events for ongoing trends. Why most investors buy the wrong thing at exactly the wrong moment. One of the most common and dangerous investing mistakes is the belief that the current trend will continue. Which, the market is something at my point of view. And you can say whatever you want. At my point of view, it is actually something that's unpredictable. There are people and there are systems, at my point of view, or just, by my knowledge, I know that they can actually some kind of predict it. The thing is, everything can happen. Everything. So yeah, there are definitely patterns that, will come and go, but, really being 100% accurate will never be the case. So the solution is don't sell out. Rebalance. What the best investors in the world do is create a list of simple rules to guide them so that when things get emotional, they stay the course and remain on target long term. And it's just so fucking great that he points out, or just he uses the word long term, because at my point of view, the long term decisions are always the best decisions. And also some kind of the fastest decisions, because it's, all about the speed nowadays. But just, these are the reasons why why I'm working out, why I'm eating healthy, why I'm meditating, why I am taking cold showers, why I'm doing this right now. This might be even the best example for it, because I do get nothing out of it. Maybe some happiness. Yeah, definitely happiness, because it's making fun and being in a good mood in terms of knowing that I actually am doing something for my future right now, and that I'm building something up for me for my future right now. This is, the other side. So this is, quite the short term thing, besides, really not being sleeping a lot, which is definitely something I just want you to understand, that you have to sleep. I'm sleeping only 6 hours and it feels like I need more. And if you feel like you need more, just please sleep more, and just, schedule everything that you can sleep more. Because I really just really recognize that my health is not doing that well. Some kinda. And, I'm pretty tired. Everything is a little bit not that great. But the thing is, I know that I need the time, and I kind of need the time. I actually need it. The thing is, please don't do this. If your body is saying you need more of sleep, if you need more of, this and that, if you just really cannot rely on your body, this is some kind of also fact of it. Because, I often think like, yeah, if your body is really telling you that you need that chocolate right now, there's something going on with your body that's not correct. But if you can really rely on your body, and he or she or it actually, I guess, is saying that you need more sleep, then please sleep. Please. My body is telling me, but maybe I'm quite resisting. But I initially wanted to say something else. Fuck, man. So long-term decisions, even though there are quite really short-term benefits of meditating and taking cold showers and eating healthy and doing this right now, the long term just is a little bit overwhelming. This is not something I just want to be like, yeah, and this is so great, you can just get it immediately, all this happiness and whatever. It isn't the case. Some kinda. Because through working out, I know I will be healthy in 60 years from now as well. And if I'm meditating, I know that this is good for my mental health. And if I'm taking cold shower, yeah, this is also good for my body and so on. So yeah. Mistake 3, overconfidence get real. Overestimating your abilities and your knowledge is a recipe for disaster. We constantly overestimate our abilities, our knowledge, and our future prospects. The solution is get real, be honest, and when it comes to investing, self-deception may be the biggest expense of all. Mistake 4, greed, gambling. So greed, gambling, and the quest for home runs, it's tempting to swing for the fences, but victory goes to the steady survivors. The best way to win the game of investing is to achieve sustainable long-term returns. But it's enormously tempting to swing the home runs, especially when you think other people are getting rich faster than you. And this is actually some kind of thing that I'm really thinking about. Some people are actually rich, or were actually rich when they were just, or had the same age as I am now. I am now 18 years old. A lot of people just have accomplished so fucking more than I have accomplished in my fucking life. The thing is, it's really some kind of bit stressing me out, because I feel like I do not have the time. But then I really get to understand that, and I get me to understand that it's about being patient in the macro, which means in the big picture is about being patient. The small one, so in this whole picture, everything in this is about taking action. So in the micro, it's about taking action. This is something Gary Vee is, really been talking about quite a lot, and I've never understood it, but now I understand it, because it makes sense. Actually you should be patient, but actually not being patient in terms of being passive. This is not the good thing, but being patient in the long-term view, or in the big picture, the whole thing, the macro. But in the micro, you shouldn't be doing nothing, because this wouldn't make any sense. You should be acting and, actually working on things you like to do, and, just try to monetize your passions, so that you can kind of make them to your work, so that you do not have to do things you do not actually want to do. Mistake 5, staying home is it's a big world out there, so how come most investors stay so close to home? Humans have a natural tendency to stay within their comfort zone, which makes sense. The solution: expand your horizon by diversifying internationally. You're not only reducing your overall risk, but also increasing your returns. Mistake 6, negativity and loss. Aversion, your brain wants you to be fearful in times of turmoil. Don't listen to it. The trouble is, losing money causes investors so much pain that they tend to act irrationally just to avoid this possibility. And the thing is, if you just have once made a mistake, the possibility of making mistakes again is pretty high if you just are really crippled by them. This is something that kind of was staying in another psychology book I was going through on this channel as well. But the thing is, just go on. You made a failure, learn from it, go on. Something I have to remind myself as well, because I tend to forget it. And the fears it can trigger is to be prepared for it. So these were the 6 mistakes, and this will be it for this episode today. I hope you got a lot out of it. Speaking went kind of well, lately, and also because of me not really sleeping a lot. It's kind of a little bit, not that great in terms of finding words, reading through fluent, and especially speaking fluent. But I hope you got a lot out of it anyways. But I really have to thank you for going through this with me, and I'll see you the next time, and I love you. See you soon, and I hope you have, I hope you're just really happy, as always.